Hi, my name is Ben Shepard, and I'm the editor of Louis Rukeyser's Wall Street. The global markets have been jangled over the past month or so as the debt crisis continues to brew in Europe, right now primarily affecting Greece. Right now there are still some questions as to whether or not the nation's going to be able to meet the spending cut targets that the broader European Union has set for it. And Greece has even resorted to bringing up 50-year-old issues in what looks like a bid to buy some time and some sympathy. But realistically speaking, over the longer term, and frankly probably even in the short term, the crisis will be resolved. The European region is kind of unique in the fact that it does have a large single unified economic authority in the form of the European Union. And the EU and the European Central Bank is responsible for setting the monetary policy for the region, but at the same time the individual member states, their own central banks are responsible for the fiscal policy in their respective countries, but those central banks don't have the authority to actually print currency, so they can't just print their way out of any sort of a crisis. So that sets up kind of an interesting conundrum, and it's going to be an important test of the European Union's strength and authority as to how this crisis plays out and how they ultimately end up resolving it. The most likely outcome, and I think the outcome that most people are expecting, are that the larger, more solvent member states such as Germany and the UK and even France are going to step in with a bailout package, possibly in conjunction with the IMF, though that doesn't appear to be quite so likely, if for no other reason than the current head of the IMF is a political rival of France's Sarkozy. But realistically speaking, I think now is an excellent opportunity to gain some exposure to some really solid European companies. You know, last year a lot of people were saying avoid the U.S., but over that time frame we've seen it play out where the larger multinational, really strong businesses here in the U.S. have rebounded strongly, are performing extremely well, profitability is improving. So it's a very similar situation over in Europe. That being said, I would take a more diversified approach. I don't know that I would dip into too many individual names, with the possible exceptions of companies like the pharmaceutical giant Novartis, the British banking bigwig HSBC, kind of those larger, more blue chip names. But I do definitely like some funds in the region. For ETF investors, the Vanguard European ETF, the ticker symbol VGK, is a really great low-cost option. Its expense ratio is only 0.18%. So it's extremely cheap. It's extremely well diversified. The PIG nations actually make up just a very small slice of the pie, considering the broad scope of the fund, really making up less than a third of the assets, with the UK being the single largest country exposure. And so far this year, the ETF sold off in the neighborhood of about 10 to 12%. So this is really an excellent buying opportunity to get in on that, and if you can sit on it probably for a year or so, you should see some nice capital gains. My favorite mutual fund in the region is the Homestead International Value Fund, HISIX. James Chaney has been the manager there for about 5 years now, and he's the lead manager of a team of 6. And they take a very strong value approach to their holdings. They've really got to see a discount to intrinsic value before they'll buy into a company. So that gives the fund some cushion on the downside, assuming it takes things maybe longer than expected to play out in the region. And actually in the past few weeks, the fund has gained quite a bit of ground as people are coming around and appreciating the fact that Europe will recover. So those are my two favorite funds, the Vanguard European ETF, VGK, and the Homestead International Value, HISIX.